Good day guys, welcome back. Hope you are well, and in this video we are going to talk about a managed fund by BetaShares that has been listed recently with a ticker code QMAX, also called Nasdaq 100 Yield Maximizer. So we're going to talk about what is it about, what is covered call strategy, and then we're going to do a comparison with Nasdaq 100. And of course, this video is not a financial advice, it's purely informational, and we're going to go through some of the risk investing with this strategy. So let's have a read with what BetaShares has written about this fund. So BetaShares Nasdaq 100 Yield Maximizer Fund, a managed fund, ASX QMAX, aims to provide regular income along with exposure to a portfolio of the top 100 companies listed on the Nasdaq stock market. So there's a keywords there, we're gonna talk about it later. Regular income and Nasdaq 100. In addition, the fund aims to provide lower overall volatility, so lower volatility, we'll talk about that as well, than the underlying Nasdaq 100 index. QMAX does not aim to track an index. QMAX provides access to the companies that make up the Nasdaq 100 index. It employs an active covered call option strategy. That is a long-ass name for a strategy. Active covered call option strategy that seeks to generate income over and above the dividends paid of the underlying portfolio. We'll see about that. In times of heightened volatility, the income generated from QMAX covered call strategy can be particularly attractive as option premiums rise with an increase in volatility. So this is a strategy that apparently prefers a volatile market, meaning it goes up and down a lot. So one day is up 1%, next day down 5%, the next day up 6%. This strategy prefers that. And then they're talking about YMAX and UMAX. That is another yield maximizer fund managed by BetaShares, with the only difference YMAX is looking at ASX 20 and UMAX is looking at S&P 500. Let's carry on. QMAX provides investor with attractive income paid quarterly. It's not as regular as monthly, but more like 4 times a year. And then portfolio diversification, okay, and lower portfolio volatility, we got that. And cost-effective exposure with management fees of just 0.68% per year. So what is a covered call strategy? I'm going to show you a clip of the video where I explained a covered call strategy, where I was talking about another BetaShares managed fund with the ticker code YMAX. So let's check it out. So briefly, let's talk about what is a covered call strategy they are talking about. This strategy is also called buy right strategy. And if you are not really familiar with the call option gives the buyer of the option the right, but no obligation, to buy an asset at the strike price. Each option has the expiration date. Covered call option is when the seller of the writer of the option already owns the share in the contracts, hence the term covered. It's different from a naked call where the seller, the writer of the option, doesn't own the shares, and usually they need to show a cash as a collateral instead. It seems like covered call strategy is a strategy that gives you an option premium that will be given out as dividends, but the risk is that you're missing out on the potential upside, because the upside is capped at the strike price. And don't you worry, we'll do a comparison with Nasdaq 100, or at least the past 5 years comparison, and we'll see if the generated income really over and above the dividend from the portfolio. Now, since the potential upside is capped, it's not really a good idea to use this strategy on a strong bull market. And Nasdaq 100 for the past 5-10 years is one of the best performing stock market, even outperforming S&P 500 for the past 5 years. And even BetaShares mentioned this when they're talking about YMAX. And here's the old clip where I talk about this. So through the paper, they talk about the risks of buy right investing. Investor risks include the share price falls, because the investor will generate cash by selling the call options and receiving option premiums. So the downside risk is less when the calls are sold than it would be if the shares were held outright. Because if the share price is below the strike price of the call options pretty much becomes worthless, and therefore seller of this call option gets the premium and gets the profit. Another risk is that the share price above the strike price of the call options. In this scenario, the investor will still receive some gain of the underlying share, but that share will be capped at the level which the call option is exercised. So what they're saying is that your gain is limited by the strike price that you put up high. So generally they put 5 or 7%. They try as much as possible so that the option is not exercised. According to the paper, typically buy right strategies can be expected to outperform a stock-only portfolio in certain market environments, namely outperform in modest bull market, outperform in range-bound market, outperform in a bear market. However, as buy right strategies involve foregoing some of the return from price appreciation of the relevant securities, such strategies can be expected to underperform in a strongly rising market. Now let's do a comparison with Nasdaq 100. ASX QMAX is just been listed, I think, since October this year, so it's really new, so we don't have data from it. But apparently, in Nasdaq stock market, there is a Nasdaq covered call ETF provided by this fund manager called Global X, and he has a ticker code QYLD. And unlike QMAX, they provide monthly distribution instead of quarterly. And they do the same marketing, is that they're promising a high income potential. And the total expense ratio is about 0.6% per year. And we can check out their performance since inception of 5.2% per year. And they've been listed since November 2013, so that is almost 9 years till October 2022. So since inception, return is 5.2%, but you're not gonna like the unit price growth since inception. It is bloody red negative by negative 37% or annualized about negative 5% per year for the past 9 years. And if you invested in Nasdaq 100, say ASX NDQ, since May 2015, after 7.5 years, you would have get a gain of 162% or annualized about 13% per year. But if you invest with NDQ, you don't get the distributions as if you invest with QYLD. Again, I'm not trying to sell you QYLD or NDQ or QMAX. I'm just simply trying to give you informational video and laying out the risk, because it's just a different type of strategy. I just want to make sure that you understand the strategy and not be misguided with the marketing and the fancy words that seems too good to be true, like lower volatility, over and above dividend yield. And if you're interested to understand more, I think you can watch this video. It's quite long, about 20 minutes, but I talk more in detail about WIMAX, a covered call strategy that is covering ASX 20 companies.